International, joining in to talk about exactly that. Manoj, hi, morning. Great to have you on ET now. Manoj, this LPG shortage is affecting very many industries. Tell me whether it's impacting operations at Bikaji Foods at all.
Not to that extent, actually, because most of our production is in Bikaner, and which is not as much dependent on this gas. We use coal. But I mean, if it continues, I think it would impact. And also for our satellite units, yes, it would impact our business.
So are there alternatives that you're looking at for satellite units as well to maybe try and switch to coal or induction cooking, etc.?
Yeah, so that will be the second option what we'll have to work on. But this transition would take some time in that case.
How much time would it take, sir?
So it would take at least two to 3 weeks kind of our stuff would get disrupted because arranging for that stuff, furnaces and all that stuff. So those are the mechanical or technical changes one would have to do.
And Mr. Verma, does that basically create a drag on your financials? Is demand strong for you, or does the fact that you've got adequate inventory kind of take care of the 2 to 3 week lag, especially in terms of select production?
So first and foremost, if you look at about 90% or close to 90% is what we produce out of Bikaner, where it will not get impacted, right? It is only about the 10% kind of our stuff. We would try to manage it from demand lens. There's not as much an impact, but yes, from cost lens, if you look at the bottom line, the way the packaging material prices and to a certain extent in oils, the prices are going up. I think the Q1 would get impacted on this stuff.
Okay. And would you have any sort of back of the envelope calculations? If at all, do you sense an impact in Q1? How much could it be?
So I think it's too early to say. We still have few days in this quarter. And what we are contemplating on is that we'll have to pass some prices to the consumer. I mean, we'll take some price increase if this continues. So as to ensure that we manage our bottom line numbers as well.
Understood. So as of now, and Manoj, I just want to get the record straight here. You're saying it's business as usual. As of now, you're not seeing any impact, right? Because of the LPG shortage?
Yeah, for now it is okay. It's as usual, yeah.
And how many days of an inventory would you have in terms of LPG supply, post which you will see an impact?
So see, it's an ongoing stuff kind of a thing. You do not control. It's not like coal that you store it with yourself. These are bookings, and you may get to hear some say bad news immediately also in that case. So we are prepared for that stuff, that if it comes through, we'll manage with our inventories at our depot, at our factory premises and all, so as it impact the least on our business.
Talk about your distribution expansion as well, because that has always been a very key growth driver for your business and a lever at that as well. Tell me, what progress are you making toward targeting that around 50,000 direct outlets annually that you had planned?
So we are very well on track. So the numbers what we said, we would cross 350,000 outlets as our direct reach by end of this financial year. I think we'll exceed this number only. This is well on track. As of last quarter, we've already done 336,000 outlets.
Okay. And give us a sense as to how much of price hike will you undertake if you were to undertake that, because you suggested that there might be price hikes which you will start to take. Give us a sense of that. How much?
So I think, it would be say around 150 to 200 basis point kind of impact would maybe we'll have to take.
And that will cushion you with regard to margins entirely, and that's just from an inflation standpoint on cooking gas and LPG, or does that also cover some of the raw material costs? Because food inflation, at least on WPI and CPI, both seem to be inching upwards. I'm trying to get a sense as to whether this saddles you entirely, or you will still see some margin dilution as a result of costs going up.
So when you say raw material, so as such, raw material still is well under control. It's not as much a challenge. It is the packaging material which has gone up big time, right? When I say 150 to 200 basis point, this would take care of all that element. Unless and until something goes beyond for what we are seeing today.
So if at all, the impact will only come in Q1, Q2 of FY27. FY26 is completely built in terms of both sales as well as costs?
More or less, yes.
Understood. What's the trajectory looking like over the next maybe couple of years? What's the kind of growth clip you're looking like? How much of your new capex and your new production facilities come on stream? What are the timelines for that?
So what we are looking at it is around mid-teens of growth, continued for next 2 to 3 years kind of stuff. So this is the revenue growth, and wherein the volume growth should be around 11-12% kind of stuff. That's what we are looking at it. Currently, our overall utilization, when we say, is about 50%. And this is what in next couple of years now should be increasing by 10-12% each year kind.
The other thing, since we're talking about Manoj CapEx, is you had planned on investing about 40 crore rupees, right, into cafes, QSRs, and your catering services as well via your retail subsidiary. Tell me, what strategic role will this play in your overall business? And is that going to be a key focus as you move forward?
So this is about THF, the Hazelnut Factory, which is a premium sweets business. And we have taken 53% stake in that stuff. This is run by the founders themselves. So therefore, in terms of our focus, it does not dilute our focus in that business. And it's delivering growth ahead of what we have planned. So that's well on track.
Okay. And what about margins, therefore? You'll be able to sustain the mid-teens kind of margin number, or will that come off at all?
So margins, EBITDA, what we're talking of is about 13.5% kind of that's what we were on it. And going forward in the next 2-3 years, so we intend to increase again by 50 basis point year on year. And we want to be at 15% EBITDA margin. That's what we are looking at.
So that does not change. In the next couple of years, you'll continue to gain 50 bips. You'll go towards that 15% number, right? That's what you're essentially saying.
Exactly.
Point taken. Mr. Verma, great speaking with you. Thank you so much for coming in and giving us that perspective this morning.
Thank you so much.
All right. What we'll do is slip into a very short break. We'll continue covering